This is my review of this week's market activity as well as my own trading during the week. I will take a look at what the market did and then I'll look at the trades that I took. So this week I took three trades and they all resulted in losses. As a result, I am down 2% on the week. My first trade, I risked a full percent because I was back at break even on my account, which resulted in a loss. Immediately after that, I cut my risk to 0.5% per position and then took the two losses that followed. That brought me down to 2%. This is the importance of risk management. Whereas if I had kept risking 1%, I would have had three losses and I would have been down 3%. Now, cutting my risk in half, I would have to lose another two trades for me to go down 3% because I have taken three trades. The first one, 1%, that's a loss. Second one, 1.5% loss. Third one, 1.5% loss. If I were to take another two, that would be another 2.5% loss before eventually hitting 3% in drawdown. That's just the importance of risk management. It helps you stay around long enough to take the winning trades. And I only need one trade, maybe two, to make back the 2% that I've lost. But before we go into the trades, this is the analysis of what the week did. Now we can see that this week's, well, rather last week's candle was a huge bullish candle. Now this is the trading week, I believe November 20, what was it? The trading week of November 25 to November 29. Price started the week with a huge gap. If we go down to the daily and look at Monday's candle, this was not where Monday's candle opened. The reason is that forex.com, the chart provider that I use on TradingView, does not like to show gaps in price. It likes to show the gap as a candle, as if price opened at the low of the gap and closed at the top of the gap. To put that in better perspective, let me see if I can check out Owanda's feed. Aha. So on Wanda's feed, we can see the gap here. We can see that the prior week closed here and then last week opened here. So that was a huge gap of about 60 pips. If we go down to the, let's say, 4 hourly, we'll be able to see the actual gap in price. Yes, this was it. So you see, Friday closed here and then Monday opened here. So it was a 60 pip gap in price. But going back to my own feed, we can see that price gapped up and each gap in price creates an actual fair value gap in price. So this was it visible on the 4 hour. And remember in my forecast for the week, I had said price had rejected off of this monthly fair value gap, this monthly level, and I was anticipating a bit of bullishness, which is what we have seen play out throughout this week, trading into the weekly fair value gap that was created above price. So this is the last significant bearish fair value gap that was created before price eventually traded into the monthly level. All of this price action in between, all of this price action that happened this week, you can see that it was not very impulsive. It was pretty consistent, slight impulse, deep retracement, another impulse, small retracement, and then price eventually closed within the range. So price closed between this monthly fair value gap and this weekly fair value gap. That's important. I will discuss it in more detail in my weekly forecast video, in my plan for the trading week that is ahead of us. But so this is what price did. And since I was anticipating a bit of bullishness, at least until this objective, which is this weekly fair value gap, was reached, I was open to taking long positions as long as I saw fair value gaps forming to the upside. This was the first one. Price traded into it, gave a bit of a reaction, came back down into it to completely fill it in. Look at the precision on this candle. Look at this candle's high was 1.04255 and this candle's low was 1.04251. So you see the sort of by just a few pipettes, basically completely filled it in and then rallied away from that point. It was in this area that I took my loss. I took the loss on GBP USD, and I'll go to that in a second. Shortly after that, price created another fair value gap visible on the 4 hour. On Friday, I was anticipating this move lower to continue, tap into the fair value gap, then give me a long setup to take to the upside. But we see that on Euro USD, that did not happen. So I did not have a trade. Now, going to GBP USD, where my trading happened this week. So I took two trades on GBP USD and one trade on NZD USD. These are the GBP USD trades. Now, there are a lot of boxes on my chart. Just to explain, I like to mark my weekly, my daily, and my 4 hourly levels. Weekly levels are colored purple, which is what we can see here. Daily levels are red, and 4 hourly levels are green. I usually don't like to mark any fair value gaps that are lower than the 4 hour. I have fair value gaps on the 1 hour, those are coded blue, but we rarely see them. I only use them if I'm trying to scale into a trade, take a continuation entry. But to form my overall trade ideas, I only use the weekly, the daily, and the 4 hourly. And the reason that I keep them on my chart, so you see there's a weekly level that has a daily level inside, weekly level with a daily level inside. The reason I keep all of them on my chart is for precision. I like to see, because sometimes inside the weekly level there may be a daily level, and if you're trading just off the weekly level, you might get into the trade early because price wants to tap into the daily level. So the points where they overlap, for example, in this fair value gap, we have the point where the daily and the weekly overlap. This lighter red area is just daily. This lighter purple area is just weekly. But you see this point where the daily and the weekly overlap. A lot of the time, price will trade into that point before doing what it wants to do. That's the reason I have all of them. So let it not confuse us. If you go down to the daily, we can see that there was a daily fair value gap above price here, which I anticipated to get filled in, but it did not happen when I thought it would happen. So I thought this candle, which was Monday's candle, might be the one to fill it in. But you can see that Monday's candle traded into it, but ultimately ended up rejecting. This was where I took my first loss. Tuesday's candle traded into it again, ended up rejecting, went neither up nor down. Eventually, Wednesday's candle traded hugely, bullishly, traded through it and completely filled it in. But I did not have a setup, I did not have an entry here. Let's go to Monday's price action where I took both losses. On the 4 hour, this was the fair value gap visible on Euro USD. This was it. I have removed it so that my chart is not too cluttered, but for the sake of this demonstration, this is it. We can see it. So when price traded into it on Monday morning during London session, I had my first entry. On the 15-minute time frame, we can see the price action that got me into the trade on Monday. So this was it. Asia session traded. So this is that opening with the gap that opened the week. During London session, price traded into it very nicely, gave me a better risk to reward because you can see that the range from Asia high down into the fair value gap was a bit longer. It was a better range on GBP USD than Euro USD, which is why I elected to take the trade on GBP USD. This was my first entry. Now, again, I am trading my account a little aggressively because I have an objective. If I was not trading it as aggressively as I currently am, now I'm aggressive not in terms of my risk. Like I've mentioned, I cut risk anytime I take a loss, but I'm aggressive in terms of my targets and how quickly I scale into trades because I'm trying to hit a 10% objective. If I did not have that objective, my trading would be a lot more relaxed, and this Monday loss would actually have been a 3 hour win. This was my first entry. Price traded into the level. On the 15 minutes, you see this beautiful engulfing candle, and so I took the trade. If we see now that if I was just targeting Asia highs, right, Asia high right here, it would have given me a beautiful 3.6 hour trade. It first of all traded to the upside, Then between London and New York session, traded back down, but I did not move my stop to break even or anything. It would have eventually come back up and netted me a beautiful 3.6 hour trade. In hindsight, now I wish that was what I did, but it did not happen. We take the L, we take the lesson, and we move on. I am still fine with this result because it is the aggressive. If this trade had worked out the way I had been planning it, I would have netted about 7 hour or 8 hour on this trade. That's what I was going for, which is why I took the loss in this case. So the trade idea we can see was very valid. My edge still worked out, still played out. This was just me and the actions that I elected to take in the market. This was my initial entry. As soon as price gave this beautiful reaction, so this was the entry, when price printed this next candle, let me just take this position off. When price printed this 15-minute candle, we can see that this 15-minute bearish fair value gap was completely inversed. That is another potential entry signal when you're trying to scale into trades. When you start seeing bearish PD arrays get inversed, get disrespected on the lower time frame, you can go back in to look for another entry, which is what I did here. On the 5 minutes, let me go down to the 5 minutes. I have to go back and start looking for Monday all over again. This is my problem with TradingView. I wish it could, when you go down to a lower time frame, show you the portion of price that was displayed on the screen before you went down. So this was it. When price inversed this fair value gap and traded lower, what I like to see for me to take a scaling is I want to see price trade into the fair value gap that has been inversed and then move away from it. So this was what happened here. Price traded into it, all still during London kill zone. Price traded into it. You see, tested it. The bodies were respecting the main point, the main threshold. You see, this candle respected it, traded into it. This body respected it. Body respect, body respect, body respect, and then gave this huge bullish engulfing candle out of the level. This was what triggered me into the trade because I could see that bullish price action was still being respected. So I took this trade and I moved my stop, which was down here at this point, at this low. I moved it here to break even because I want to keep my risk static at 1%. So I put another 1% on this trade, moved my stop to these lows because if price goes back, disrespecting all these body closes, all these points, or this point where the body is respected the mean threshold. If price comes back to the mean threshold, then it's essentially going to break through it. I don't want to see price come back down here since it has already tested it and rallied away from it. So if price is going to continue bullishly, this is a good place to put my stop. Now we can see that over the course of the next few minutes, price struggled to rally away from the point and ultimately ended up reversing lower. Now, at this point, this was where my initial stop was. One might have thought that price was going to come back down and take me out of the trade entirely if I had maintained my initial position, but price never got there. Instead, it rallied. Now, after I took this 1% loss, immediately I cut my risk back in half to 0.5%. When price traded back down, and now this was the start of New York kill zone, we can see that as price never, let me go back to the 15 minutes because this entry was taken on the 15 minutes. We can see that as price never took me out of this trade, as price did not hit my stop loss, the trade idea was still valid. And so we are still in this overall 4-hour fair value gap. We are still trading bullishly. The mere fact that price retraced this deeply, as long as it did not take out this low, the trade idea is still valid. So when price engulfed this last down close candle with this candle, I saw that, okay, now we're in New York. So a lot of the time, London will rally, then reverse, then all consolidate. But New York will eventually bring in the volatility of the day. And my idea was still valid. My bullish idea was still valid. So that's exactly what played out. I took this trade here, went long here, put my stop loss below this new low that had been formed on the 15 minutes. But you see, the only problem with the trade was my target. I was thinking that the bullishness would come in. And if price is going to shift bullish, then this daily fair value gap, this 4-hour fair value gap should be completely inversed, should be traded through and completely filled in. So my take profit was at the top of the 4-hourly fair value gap. And what do we see price did? Price rallied quite nicely, took out Asia high for the day. Now, this is a perfect day trade. Took out Asia high for the day and reversed immediately after taking Asia high because it is a bearish PD array after all. It is a 4-hourly fair value gap. It's a daily fair value gap. So it does have the potential to actually push price lower. If I wanted to be more proactive, I could have just taken my profits as soon as price traded into it and then watched to see what price did. But because there was a weekly level that I was targeting above price, and I thought that price was going to get there before the bearishness would resume, I could hold before price got to the level. So this is the level. This is the level here that I'm talking about. So I did not think this level was going to push price back down, especially as we're coming from the monthly fair value gap. In hindsight, of course, I could have made a better decision. And that's why it's important to just react to the market, not try to predict it. This trade offered me a beautiful 3.3, 3.2 R after I had already taken a loss. So the market gave me many opportunities to make money on that day. But because I was trying to predict the market, I thought price was going to go where I wanted it to go. And because I had a profit target, I ended up taking a loss. So my stop loss, as I mentioned, was here at the top of that fair value gap for a 4.6 hour trade. And although price gave me a beautiful 3.2 hour trade, I was still holding that trade. Now price retraced. Of course, there are all these fair value gaps that price left. So when it started retracing, I didn't think there was anything to it. Eventually came all the way back down to this point. Let me just get rid of this too. Came back down to this point, filled in this fair value gap. And you see when it gave this 15-minute bullish engulfing candle, my confidence in the trade returned. I'm like, yeah, finally, we're about to go back and test these highs. But that did not happen. Huge bearish candle took me out for a loss. So on the day, I was down 1.5%. Now for the following days, price did not give me any entries. You see that the next day, Asia just traded low, came back up, traded back, tested this fair value gap again. But at this point, it has already tested it 1, 2. This was the third time. I'm not going to take a short trade from there. Even if I was going to, my entry would only have come here for a terrible risk to reward. So I was just observing price. This was my GBP USD trade. The other trade I took was on New Zealand dollar. It was a short trade that also resulted in a loss. Now, at this point, I was thinking, okay, price is not respecting the bullishness that I thought was stepping in. So what I did was price traded into a 4-hourly fair value gap on New Zealand dollar. This was it. I had an alert set here. Beautiful setup. Now, price throughout the week, right, had been consolidating. Just look at this. Price had been consolidating. So this was the week's price action, right? This was that gap, Monday's gap. You see that price didn't go anywhere, went up, came down, went up, came down, went up, and traded into this 4-hourly fair value gap. When price traded into this 4-hourly fair value gap, I was thinking, okay, since price has been ranging, maybe it wants to come back into this range. And you can see that a 4-hourly fair value gap was created here. So if price trades into this level, you can reasonably anticipate price to trade back lower, at least into some bullish PD array before ultimately continuing back to the upside. On the 15 minutes, when price traded into that level, you see now this candle, this was another red flag I should potentially have noted. I'm aware of it, and depending on how I feel about the trade, sometimes I take them, sometimes I ignore them. This was the candle that traded into the 4-hourly fair value gap. Big bullish candle. Now, this first bearish candle, you see, did not engulf it, did not even as much as trade to the halfway point of this one. This second one as well did not engulf it. But this third one eventually closed below this candle's open. And so when I saw 3 consecutive bearish candles, I'm like, okay, it's not the sort of momentum that I want to see. It's not, for example, it's not like this candle, that is very huge. I would have preferred for one candle to engulf it, but it did not happen. Still, I took the trade. And again, my risk was only 0.5%, so I did not mind taking the trade. You see that price just went nowhere, did not give me any profit. Ultimately took me out for a loss. Now, in hindsight, yes, the fact that there was no momentum engulfing this candle could have been a red flag. These things reduce the probability of the trade playing out. They don't automatically mean that it's going to lose, because I could very well have avoided this trade and price would just keep trickling down. That would have annoyed me more, right? So these are the things that we need to balance. If everything sets up picture perfectly, then we have more confidence in the trade. There's higher probability. But the mere fact that everything does not look perfect, does not mean the trade idea is invalid, does not mean that you should not take the trade or that the trade will lose. So the decisions that every trader has to make per time are: how would I feel if I take this trade and it's a loss versus how would I feel if I don't take this trade and it plays out. A lot of the time, it's worse to look at a trade that you think has a possibility of playing out and to sit out because something wasn't picture perfect and then to miss out on those profits. I would rather go in with a small position size and take a loss. So I know that I executed on what I thought was going to happen and I took a loss. So every other thing was perfect during London kill zone. Price had taken out Asia high, traded into a 4-hourly fair value gap that was the premium of a range. It's not only because the engulfing candle was not a single candle that I wouldn't take it. And of course, if you go to the higher time frame, these three candles might have been a 30-minute engulfing candle, right? And I would have taken the trade anyway. So this was my activity in the week. Okay, the final thing I'll look at is the missed trade opportunity. Now, another thing is that this trade did not present itself on GBP USD or Euro USD. It was only on New Zealand dollar, right? And it's always better to take the best trade out of a trading opportunity that presents itself on all the pairs that you look at, especially the dollar denominated pairs that tend to move in sync, than seeing it on only one. But this was the trade that I missed on GBP USD on Friday. The reason I missed it was I was looking at Euro USD for the trade. So on Euro USD, we can see that after the bullishness, let me go to Euro USD just to show what I'm talking about. On Euro USD, let me go to the daily. Now on the daily time frame, we can see that price traded very, very close to the weekly fair value gap that was sitting on top of price. Now on Friday, remember I mentioned that I was anticipating price to trade either into this 4-hour fair value gap for me to take a long trade into the weekly level. But since price did not do that, if price goes to my weekly, see there are relatively equal highs here, this high, daily swing points. If price had traded into the weekly fair value gap on Friday and given a rejection, I would have taken a short-term short trade aiming for this bullish fair value gap as my target, because the week had essentially rallied, and in the ICT circles it's what we call the TGIF trade, where on Friday price retraces into the range that was created during the week. So if the week is bullish and on Friday trades into a higher time frame PD array, there's a tendency for price to turn bearish, not, of course, not reverse the whole week's range, but a good 40, 50 pip move you can tend to expect. So this is what I was looking at. Unfortunately, you can see that price did not take out these highs, did not trade into the weekly level. And so on Euro USD, I did not have a trade. If I had only looked at GBP USD in that moment, I would have had a trade. So we can see GBP USD actually traded into the weekly fair value gap that was sitting on top of price. Look at these relatively equal highs. Look at this. Beautiful relatively equal highs sitting right below a 4-hourly fair value gap, nestled inside the weekly fair value gap. If I were looking, now I did not have an alert and I was looking at Euro USD. That's why it's good to look at all the pairs that you trade. So this was it during London session. Beautiful price action. Took out all those highs. Let me see how far back I can go in price to show you the highs that I'm talking about. Yeah, so this is the trend line that denotes the highs. So you see that on the 15 minutes, price took out, of course, New York high, took out Asia high, took out those relatively equal daily highs. Price traded into the 4-hour fair value gap that was sitting inside the weekly fair value gap. And look at this beautiful rejection right here. So this would have been, although it's not, this is what we call SMT, right? On one pair, a higher high is made, and another pair, a lower high is made. Now on Euro USD, the lower high was made, but if I had just looked at GBP USD, I would have seen that price actually traded into the weekly level. So valid trade idea just did not print the entry signal on Euro USD. Now, this would have been the entry. You see, single candle, completely engulf the previous one. You go short here, take profit goes above this high. And if I had target even 3 hour, now ordinarily for this sort of thing, my target would be Asia lows somewhere here for a 2 hour. But if I had even targeted 3 hour, you see that price barely just nicked it, hit the 3 hour point and then reverse. So even a 3 hour trade would have played out. Now, of course, I know the reason that price did this is because on Euro USD, price had not yet gotten to the ultimate target. And even on GBP USD, there's still a daily fair value gap sitting on top of price, still within this weekly range. So the 4 hour will give some reaction. But even if price still wants to trade bearishly, you can still, it's still within the realm of possibility for price to eventually take out this high, which is what I think it will do on Monday, trade into the point where the daily and the weekly overlap before the main bearishness continues. But just the 4 hour fair value gap alone was able to push price, what, 58 pips for a solid 3 hour. I missed this trade because I was looking at Euro USD. And so I had two potential winning setups. So this was a week that could have been 6 hour, okay, minus the New Zealand trade. So I could have had 5 hour this week. Instead, I had minus 3 hour and minus 2% on the week. I'll tag this week missed opportunity. We learn and we move forward from it. But the good takeaway is manage risk.